Good morning, good afternoon, everyone. Thank you for joining the webinar session. While I'm waiting for a couple more minutes for people to join, as I see numbers still rising, so let us give everyone some time to join and we will start very soon. Welcome to everyone joining just now. We are still giving a couple of minutes for everyone to join the call and we will start very soon. Welcome everyone who has just joined. We are still seeing that ND numbers rising, so I'm still giving a few moments to give everyone a chance to be present when we start. All right, it is 3 minutes past, so I will get started. And in the meantime, whoever's still joining, they can join. Welcome everyone. Good morning, good afternoon, depending on the time zone you're joining us from. This is a webinar on sustainable finance in Australia and internationally, and this webinar is part of our RSM Spotlight Sustainability webinar series. If you would like to also see other sessions, either the past ones or the upcoming ones, you can check our website. In the chat, there will be a link to the website, to the full list of the webinar series. For the past ones, you can watch recordings or also access slide decks or other information material, and you can register for the future sessions as well. Without further ado, let me get started on the topic. So this is the agenda of what I would like to discuss today and present to you. First, we'll briefly touch upon what is sustainable finance to just get everyone on board in terms of understanding of what we are talking about and how we're framing the concept of sustainable finance and the conversation around it. I will look into what are the key elements of regulatorily sustainable finance frameworks. And I stress the word regulatory here as opposed to private sector sustainable finance frameworks. We could be talking about private sector sustainable finance frameworks as well. However, not in this call today. That could be perhaps a topic for another call. I will be looking at the recently released Australian Sustainable Finance Roadmap and what it entails and how that contributes to the overarching regulatory framework for Australia. I will also be looking a little more in detail into taxonomy developments of sustainable finance, both in Australia and internationally. Also some insights into developments in investment product labeling in terms of what's happening, an update again on developments internationally and locally, and then a practical insights into what are the different steps that different entities can do, either those that are already engaged in sustainable finance or are themselves in financial services, or those who are interested perhaps also accessing sustainable finance or be attractive to sustainable investors. All right, so let me start with introducing the concept of sustainable finance. Generally, when we speak about sustainable finance, there are different ways of phrasing it and different definitions. And therefore, I wanted to put a definition on the slide to really frame this conversation in a very specific way. Well, first of all, when we talk about sustainable finance, generally we usually talk about any form of financial service, product, or instrument that integrates environmental, social, and governance criteria, ESG criteria, or sustainability criteria in the way the service or product is provided, or in the way the investment decisions are made or lending decisions are made in relation to this product or service. So this is a really broad definition. Generally, when we talk about what is the purpose of sustainable finance, there can be different purposes of that. But the specific purpose that I would like to focus on today in this session is the purpose of channeling private sector capital towards activities, businesses, and projects in the economy which contribute to various sustainability goals. And we're talking broadly, we're talking about environmental goals, we're talking social goals. So we're not limiting ourselves to any specific area of sustainability, but broadly channeling private capital into these activities that support these goals. And that would over time then lead to increased investment in long-term and sustainable activities in our economies. Why I'm saying that this is a more narrow definition. There can be other purposes for sustainable finance, and I can always point out where that could be the case. One of those, for example, could be a more stable and sustainable financial system by integrating and managing sustainability-related risks, right? So this is a different aspect and a different perspective on sustainable finance. It's not about how do we channel private capital into something that's sustainable or contribute sustainability. That perspective is more about how do we make our economic system more resilient to sustainability related shocks and impacts. However, that aspect I will not be covering as much today. And then there can be other aspects of sustainable finance as well. For example, in development context, we talk very often about climate finance, about more developing countries providing capital, which can be both public and private, for developing world. So that is again another aspect I will not be talking as much today. Today we're really focusing on the different ways that private capital can be provided, mostly to private sector activities to drive investment into sustainability objectives, but also in sustainable businesses and projects. On the right side, there are the typical instruments and products. Again, a little bit of disclaimer and caveat. The terms sustainable or financial instrument or product are being used quite differently in the world, and different jurisdictions also define them differently in legal terms. Here, I'm using them interchangeably and more in a general way, because if we start unpacking exactly what the definition is legally, then we will be getting lost in between the trees there. For example, in Europe, something like bonds and shares would be called instruments. In ASIC language in Australia, that would be called a product, right? So even the same instruments or products are called differently depending on where you are. So therefore, we'll not hang up on the specific terminology here. We're using that more generally and interchangeably today. Now, in terms of what are the typical products, you see quite a long list there. And in fact, it can be any type of financial product, service, or instrument that can be sustainable, right? It really doesn't matter. What matters here is whether there are certain aspects of sustainability that are integrated into this product or in the way this product is being delivered, right? So that's what matters in terms of what makes a sustainable finance service or product as such. So why are we even caring about sustainable finance, and who should care about it? And here there's a busy slide that describes the different benefits of sustainable finance for different stakeholders. And I'm sure everyone in the call can place yourself somewhere in these three pillars here of different stakeholders. And you can start looking through and seeing what could be the potential benefits for your engagement with sustainable finance specifically. And I will just call out a few of them, as we don't really have much time to deep into every single detail and benefit. For the investors, the capital holders, capital providers, asset managers, that also includes lenders, our banking sector, there are clear advantages in engaging sustainable finance. It is currently very much about your both reputation, sustainability credentials, sustainability commitments, living up to your commitments, and doing that in a way that is robust and doesn't lead to claims of greenwashing. It is also about risk management, because investing in long-term sustainable activities or lending to long-term sustainable activities will safeguard you against sustainability-related risks or exposure to those risks in your portfolios as well. So these are really strong drivers currently that we see among investors and lenders. It is their own sustainability commitments, living up to those commitments. It is the risk management. It is improved reputation. It also is market opportunities. As a sustainable investor, you will be interested and you will interact much more with companies that are define themselves as sustainable. And very often these companies are in the so-called future industries. And so they are forward-looking, they are innovative, they're integrating technology, and they are likely to be sustainable and in demand in the future economies. There is a potential for enhanced returns as well, and sustainable investment it is not only about impact or purpose. There can be potential enhanced returns. It doesn't always happen. It does depend on the instrument. It does depend on the market. But potential is there. And sometimes in some markets, and again, depending on the type of the product or instrument, some of these investments can display lower volatility, right? And so there's certain resilience that you can achieve in your portfolios because of that lower volatility. We especially saw that during COVID times, typical sustainable investments were quite stable in terms of their returns and did not display the volatility that the rest of the market did. For companies and financing recipients, the main interest here, of course, is access to capital. And sometimes this access to capital, when it is defined as sustainable capital, can come at a cost saving, meaning this capital comes at some discount, right? So, for example, sustainability linked loans would be offered at a lower interest rate if you fulfill the agreed sustainability key performance indicators. Sometimes you get better pricing for your bond issuances and so on. So there is a potential that when you are assessing capital, if you can demonstrate high sustainability credentials, then your access to capital aid will be easier, but also potentially at a lower cost. It allows you also access to capital that supports innovation. Very often sustainable investment capital is a little bit more patient capital. It is more longer term looking or medium term looking. It doesn't always expect immediate returns, although that can also be the case. But we do see that sustainable capital, especially impact investing, has that longer term perspective and therefore maybe more patient and support you while you're building out your product in an innovation stage. And of course, long-term viability, access to sustainable finance generally supports your business sustainability and resilience, and also your engagement with sustainability as such gives you that benefit. And of course, there's also benefits for the public sector. The role of public sector here in sustainable finance is that there are various roles, right? But one of those roles is setting the policy targets, both on sustainability policies, both for economy, both for the financial system, and also for international collaboration. And by enhancing sustainable finance in the private sector, the public sector also benefits because this helps them achieve their own goals that have been set in the policy, be it climate change mitigation, greenhouse gas reduction targets, be it protection of biodiversity, social targets, social goals. All of that can be supported and enhanced by private sector engagement and by channeling private capital into helping achieve those goals. And that, of course, releases the pressure on public funds as well. And as I said, any goals can be achieved, including the social ones here. Generally, it does stimulate economic growth. Typically, sustainable industries do create new jobs. And as I said, they create the jobs of the future, meaning long-term jobs that will be there and will be in demand in the future economy. And we can, of course, think of this as a general improvement of the fiscal health because this investment in these future and sustainable activities and businesses reduces transition risks and other types of sustainability risks that come with that. So these are the benefits, and I hope you're realizing these already in your everyday life. And I'm also happy to hear that if you have any comments or insights on that. So during the webinar, you also have access to a Q&A button. You should be seeing that on your screen. If you click on that throughout the webinar, do not hesitate. Start typing in your comments and your questions. I will leave time at the end so I can address at least some of your questions. So drop those in whenever you feel like doing that. Okay. So let me go forward and talk about what are the numbers. How is the sustainable finance market looking at the moment? And it's looking quite encouraging, despite some of these shocks that we have gone through COVID times and cost of living crisis and so on. We're still seeing fairly positive numbers coming out of the sustainable finance market. The assessments of sustainable finance markets can differ significantly because the definition of what is called sustainable finance or sustainable investment or ESG assets can differ significantly as well. On the top, the first dot point there is a Bloomberg data point that is based on GSIA methodology that uses a very broad definition of what ESG assets are, and therefore they estimate that currently the market has already surpassed $30 trillion and is projected to grow to 40 trillion by 2030, reaching around 25% of all global assets by that time, and assets meaning assets under management. And so you see quite a lot of statistics there added, that there also, we see some instances where sustainable funds are outperforming the usual types of funds, and then that's been seen across all major asset classes. This is Morgan Stanley data that we're seeing that the median returns in 2023 of sustainable funds were almost 50% ahead of the traditional funds, right? So when we speak about the potential for higher returns, there certainly does exist. Does not always exist across all product types, but there are certain product types that certainly benefit from that. And when we speak geographically, where are these investors mostly located, or also these assets mostly located? Europe always stands out significantly. ESG assets, according to Bloomberg, they determined that for 45% of global share is in Europe. Morgan Stanley, who look at more narrow definition of sustainable investment, looking really only at the funds that declare sustainability as being their objective. When we define it even more narrowly, then the share of European assets under management increases to 87%. So you can see that really Europe is driving a lot of the sustainable finance market. However, that is not the only market. Certainly other markets are also active. And Australia is specifically called out as a comparatively small but very rapidly developing sustainable finance region as well, alongside with Japan and Canada, for example. Some of the graphs below illustrate the growth of green bonds and sustainable funds. We did see a little dip during COVID, and especially in 2022. However, we see how those trends are recovering over time. And some of those dips, especially in the sustainable funds graphs, are actually caused by changes in methodology in the way we account and count sustainable funds and how we define it. As you can see, that green line in the top graph under sustainable funds does not show that dip. So the percentage of the whole assets under management has percentage-wise, the sustainable funds of that haven't dipped in 2022, although the absolute numbers did. So there are some methodological adjustments as well, not just, it doesn't always illustrate outflows of these funds. And issuances of green bonds and social bonds are also on the rise. In Australia, the trend is significant and developing rapidly. Globally, and here we're not, again, comparing apples and apples. Globally, the global graph shows not only green bonds, but also social bonds and sustainability linked bonds. So that's a broader scale. The curve is slightly less steep, but still upward going trend there as well. So certainly, there's a lot of demand for sustainable investment opportunities in the market. If you are a company trying to fundraise, this is currently your opportunity if you can demonstrate high sustainability credentials. Let's go through some of the key elements of sustainable finance frameworks. And again, stressing these will be regulatory sustainable finance frameworks. When we speak about sustainable finance frameworks, generally we can classify them in three key building blocks that are necessary for the framework to function, run, and actually drive that engine that drives the private capital investment into sustainable activities and sustainability objectives. And as I will be talking through these elements, you will see that almost every sustainable finance framework in every jurisdiction can be mapped to this theoretical approach. So let's start with the first one. The first one, what we call, is sustainable finance taxonomies. Many of you by now will have heard the term sustainable finance taxonomy. They use different titles, sometimes in different jurisdictions: taxonomy of sustainable economic activities, green project catalog. Sometimes the word taxonomy is not even used, but the concept is the same. A taxonomy is a definition of what in that given economy is objectively sustainable, right? We need that common understanding and a common definition that is used by all stakeholders involved in this economy and in this investment cycle to be able to agree on what is sustainable as an activity and therefore what is a sustainable investment. And that's exactly what taxonomy does. Taxonomy generally can be divided in two main types. Some of them are criteria-based and some of them are principles-based. And let's go a little bit in detail describing that. I want to dive a little bit deeper in what taxonomies are, because this is really important to understand that. So sustainable finance taxonomy is a classification system that defines the rules and or criteria that determine whether certain economic activity, project, entity, business is sustainable or not. So you have an assessment tool. Either those are principles or criteria against which you can assess your target assessment or yourself as an activity or business, and you can determine to what extent you are aligned with this definition of sustainability. There are, so as I said, two taxonomy architecture types. Let's start with the criteria-based taxonomy. The typical taxonomy architecture of criteria-based taxonomy is as follows here in this graphic. This has been spearheaded by the EU taxonomy. EU taxonomy, European Union taxonomy, has been one of the first ones. It is by now one of the most developed ones. It is also very comprehensive. It has very broad coverage. It is used internationally extensively. It is used by governments who are now developing their own taxonomies as first point of reference. Very often, whenever a jurisdiction wants to develop a taxonomy, they would be looking at the European taxonomy and see whether there are any elements they can take over, at least in the architecture, to align and use the same principles. And also, international investors use very often EU taxonomy as an international taxonomy for their sustainable investments as well, especially for those areas where there are no local national taxonomies adopted just yet. Therefore, this architecture has been entrenched and has been taken over in many other taxonomies around the world as well, and is broadly accepted. So the way the architecture looks like is that each assessed activity or business has to substantially contribute to at least one sustainability objective. Each taxonomy can define different sustainability objectives. Some of them target only one, most of them target several. It can be environmental, it can be social, but at least one of those, the activity has to contribute significantly or substantially. And for that, there are specific criteria defined that you need to fulfill to check whether you are actually contributing to that required extent. Now, these criteria are usually called technical screening criteria that you need to apply. And then the next step is you have to comply with the do no significant harm criteria, because if you have a number of objectives, you want to make sure that when you are significantly contributing to one of those objectives, you do not want to be harmful to another objective. If you're good for climate, you are reducing your greenhouse gas emissions, you do not want to be harmful to biodiversity or pollution or water management or any other sustainability objectives. Therefore, there's this other set of the screening criteria, which are called the do no significant harm criteria. These are usually set at a lower threshold. You're simply not harmful to the other objectives. And another check typically is some sort of social safeguards. Minimum social safeguards is the terminology used in the EU taxonomy. There are other taxonomies that call them in some different ways. But usually you also want to check, especially if your core taxonomy is environmentally focused, you also want to check that you're not causing social harm, especially in the relation to human rights, labor rights, for example, modern slavery rights, and so on. So that is how typically a criteria-based taxonomy would look like and would be built. Now, there's also another type, which are the principles-based taxonomies. And these taxonomies typically would define high-level principles. They do not set specific criteria. They rather act as a qualitative guidance, and they would often define the principles and then some guidance material that advises you on how you can address and assess those principles. However, it doesn't set any quantitative thresholds, specific requirements, and that, of course, leaves this more open to interpretation by this entity that is doing the assessment. What does that mean? That there might be some differences, and there are differences in terms of how these principles are applied, which allows certain flexibility, but on the flip side, it reduces the comparability. So these assessments may work for more narrow purposes, but in terms of comparing broadly, let's say a lot of entities across the market, when the assessments are done by different assessors, will be difficult because the comparability will be significantly lower. All right, so this is a little bit of an explanation of what a taxonomy is and how it can look like, just to give you an idea. So let's go through the other elements as well here. The second group of elements that is absolutely important are the disclosure rules, because if we have a taxonomy, a definition, but no one is using the taxonomy to assess the alignment, is not reporting it either one-to-one between business partners or publicly, then there's little use of that taxonomy even existing, right? So there needs to be some sort of assessment and delivery of that information of the results. And typically for a sustainable finance framework to work well and really well, ideally, there should be disclosures that are targeted at corporates or voluntarily provided by corporates, so meaning companies, by financial institutions in terms of reporting on their portfolios and sustainability level and alignment with taxonomy of their portfolios, and also on financial product level, so that investors, be it retail or institutional investors, can easily tell and read in fund reporting in terms of what are their sustainability credentials and potentially alignment with the taxonomy as well. And then the third bucket are different supporting tools, and different jurisdictions are providing different supporting tools available in the market. It could be green finance certification programs, labeling, green bond standards, benchmark regulations, ESG benchmark regulations, rules around ESG ratings, rules for financial advisors in terms of how they need to take into account the preferences, sustainability preferences of their clients, and what kind of advice they need to provide in terms of sustainable investment options, and many other different tools. I would say that the first two are absolutely essential for this engine to run and for the capital to be channeled. Supporting tools are really in that supporting role. They do work a little bit as that oil, making it smoother. So another thing that is really important here are the interconnections. These arrows here. Because as I said, if we have the other situation that we sometimes see in different jurisdictions is that these elements are not connected. For example, there are disclosures and there are requirements or voluntary recommendations for certain disclosures, let's say for companies or for financial products, but they do not link back to the taxonomy, right? So this taxonomy remains a long-standing tool and is not linked back, and therefore the driving off identification of which are the sustainable businesses and sustainable investments is more limited, and so it moves a little slower, a little less smooth. And the same, sometimes the supporting tools are linked with taxonomy and sometimes not. Ideally, if we want this to function well, we want that linkage. Now, this is the theoretical high-level framework. As I said, I've left out certain aspects that do not cater directly to the objective of driving the investment. For example, the financial stability to ESG-related risks and international work. That's not something I have included here, as my focus today has been a bit more narrow. All right, so let's see and try and see how this plays out in some jurisdictions. I've been talking, go back. Forward, talking about Europe. So let's map the European system. As I said, it's one of the most developed ones, so we can expect that quite of these elements will be in place in Europe. And when we map that out, we can see that indeed a lot of these elements are in place. They're already adopted. Many of them are mandatory. Others are adopted and voluntary. And there are certain elements that are still being developed. But we see this being put in place very rapidly, and also the interconnections between the different elements do exist. For example, the EU taxonomy, which already covers 6 environmental objectives, 13 sectors, over 150 economic activities. It links very closely to the EU Green Bond Standard, right? And it also links very closely to the sustainability reporting requirements for corporates and also for financial products. So there are clear interlinkages there. And all these elements work closely together. Let's look at another market, which could be considered somewhat similar to Europe, because it also covers a continent, several countries, which is the ASEAN market. I am choosing these examples because I myself have been and still am involved in helping Europe develop their sustainable finance framework and write their taxonomy. I've also helped the ASEAN market to do that. So what's happening there in Southeast Asia? What we see is also a taxonomy that's in development. This taxonomy is voluntary. It is the first stages of it are adopted. It's still in development, and in fact, all taxonomies will be in development almost indefinitely. That's always a work in progress. Covers currently 4 environmental objectives, currently only 2 sectors, but planned 9 additional sectors and currently 25 activities. There are no disclosure rules related to that. That is absolutely left to the individual member states whether they want to mandate any disclosures, but there's nothing on the ASEAN level. And there is a green bond standard. However, there are no interconnections in between. So the green bond standard, for example, does not refer to the taxonomy. ASEAN taxonomy is one of the rare taxonomies that has a principles-based aspect to it as well. So it has 2 parts. You can actually choose either principles-based or criteria-based option for it. All right, so let's bring everything back home and look at how that looks for Australia. So when we map the progress in Australia to this framework, then we see again that some things are being put in place, they are in development. However, it's not as developed as we saw in Europe, although we can probably judge that it's more developed than ASEAN. The taxonomy is being developed. Currently, only 1 environmental objective. 3 sectors partially have been consulted on in terms of the criteria. 3 others are in progress. We have some announcements about the development of green financial product labeling, and also on the guidance on transition finance. One of the icons is missing there, but we don't have much else there in the supporting tools. We do have, of course, in progress and about to be adopted, expected in August, the mandatory climate-related disclosures for corporates and financial institutions, so that would help. However, again, there are no interconnections anywhere currently foreseen between these elements. Okay, so I hope that gave you an understanding of what sustainable finance framework is and how all the different elements that you may have been hearing about may fit together and where the different jurisdictions and how they have been addressing this. So let's talk specifically about, very quickly, about the recently released Australian Sustainable Finance Roadmap, because that's exactly where these actions are being planned in a coordinated manner. Pillar 1 of the recently released roadmap talks about improving transparency on climate and sustainability, and that's exactly where we find the actions on implementing climate-related disclosures and also development of the sustainable finance taxonomy. You can see that I've marked these 2 tasks as in progress, as these are 2 processes that are already ongoing and well advanced. There's also the guidance on the credible net zero transition planning, and also the indication of the development of sustainable investment product labels, which are all still planned for the future. And so there's not much progress on those just yet. Where does that contribute in our map? Well, it contributes to these areas, right? So this first pillar, we can clearly see it contributes to certain elements that contribute to the overall framework. The second pillar talks about financial system capabilities, and this is the aspect that is the broader financial system aspect, and therefore will be less represented in our framework, which primarily looks at channeling private sector investment. Here, what the government foresees is ASIC to continue their surveillance and also combating greenwashing in investing community. It also responding to the systemic risks. This is where I said that this is an element of sustainable finance, although it doesn't necessarily directly drive investment. It may do so indirectly, but the main purpose is managing of the risks. It also, government does foresee addressing data analytical challenges. Really, the action here is very early stage action on assessing what are the key sustainability data challenges that do exist, and then assess the availability and quality and assist ways that government could be supporting that. I have to say that the experience from other jurisdictions shows that the biggest area of missing data really is the missing company level reporting. And the way that's being addressed typically is by introducing company level reporting, either voluntary guidances or mandatory requirements. So government is still assessing and will be considering what areas of data could be supported and provided. However, I can already say that very often in these assessments, what comes out really is the company level data that is typically missing. So how does this pillar contribute to our framework here? Mostly to the financial institution reporting and financial products, especially where the ASIC is in that regulator capacity, looking at greenwashing issues. However, not so much else to this specific elements of this framework, because the second pillar is targeted more broadly at the overarching financial system and more general support in terms of data support. And the third pillar is Australian government and leadership and engagement. So this is where we're talking about government committing itself to be an emitter of Australian sovereign green bonds. And note that there's a commitment to emit these bonds, but there's currently no commitment to develop Australia's own green bond framework or standard, for example, right? So this is more of an action where the government is demonstrating that they want to be a leader and want to be an active participant in sustainable finance market, and they will continue issuing sovereign green bonds. And also stepping up of international engagement. Again, in our framework, this does not reflect because these are activities that are more outward targeted rather than driving the internal sustainable investment cycle in the private sector. Right. So let me also now give you a quick update in terms of what's happening with taxonomy developments. I know that we're fairly short on time today, so I can't go through much detail. About 40 countries around the world are developing their taxonomies at the moment. There is a true global taxonomy in place. There's no way we can discuss all of them. We can quickly run through a bit of an update and comparison between what's happening in Australia and Europe, because Europe, as I said, very often is used as the benchmark taxonomy by a lot of international investors, both Europe-based, but also others. So this is what's happening with the Australian taxonomy. It's starting to take shape. The first elements of it have been consulted. The consultation closed end of June. As I said, the only objective addressed currently is climate change mitigation. No other environmental or social objectives are directly being addressed. The sectors, there are 6 priority sectors that have been defined. 3 of them have now been consulted upon. You can see that list on the right side of the slide. And the taxonomy is following the criteria-based architecture with the target objectives, substantial or significant contribution criteria, do no significant harm criteria, and social safeguard criteria as well. Currently, the ones that are grayed out, the DNSH and social safeguards, have not been drafted yet, so they have not been cited. I know that they are in development. I myself am involved in this process. I'm helping to develop the DNSH criteria during these weeks and months. There are certain guiding principles that are defined, and it's quite important for taxonomy to define these guiding principles because we want the taxonomy to be credible. We want it to be trustworthy, that whenever taxonomy says that something is sustainable, it truly is sustainable, and there are no issues around, well, is this maybe greenwashing or not, that it's usable for users, interoperable internationally, because capital moves, of course, internationally, which is not an easy task because when you have 40 taxonomies around the world and each of them somewhat different, it's not easy to achieve international operability fully, so you need to be selective of how you can do that. This is the comparison side by side between the EU taxonomy and Australian taxonomy. Just to give you, you'll have access to these slides, so you can take a look at that in more detail if you wish. I've already highlighted the differences. Certainly, the scale and scope is quite different. Even just the sector coverage, the objective coverage, number of activities included, and of course, EU taxonomies are adopted. It's a legal text, it's law, and it's mandatory. And there are high number of companies that already have to comply with it. I would like to focus a little bit on where the main differences are on the bottom there, right? So we see that under Australian taxonomy, there are certain aspects that are not defined yet, where there are no linkages with other potential elements of sustainable finance framework. So just a quick overview of how that looks like. So this is an example of draft activity criteria in the Australian taxonomy. And these are still draft, right? So still subject to change, and we can see they are fairly concise. The activity descriptions are fairly brief, and then they do refer to external material or appendices when needed. This is also, sorry for the titles. So this is an example of how the European criteria look like. As you can see, there's quite a lot of text. I'm not expecting that you will be able to read this. There's a description that actually defines the activity. It's very important in Europe because it's a legal text, so we have to be very precise when we describe something in this activity, because the companies will have to judge whether what they do is in or out. So we have to be precise. We cannot leave it open for interpretation. The substantial contribution criteria, again, are quite specific. They do refer to EU regulations and standards as well. But then in addition to that, we also have all the DNSH criteria for all the other objectives. And we also have the minimum social safeguard. So these are the elements that are currently not defined for the Australian taxonomy just yet. When we put it all together, of course, there is quite a few criteria that you need to look through and make sure that you're compliant to be counted as taxonomy aligned. When we look at the other aspects that are missing, so for example, links let's start with the reporting requirements. Apologies, there's a bit of a mix-up with the animations. So this is how reporting is defined in EU taxonomy. This is not defined in Australia at all. This is an example of a company reporting on their taxonomy alignment. This is a turnover key performance indicator where they have two activities. They have determined that one of them is taxonomy aligned because it fulfills all criteria. The other one does not. Each of them represent 50% of their turnover. Because only one of them is fully aligned, then their whole turnover, net turnover, is 50% taxonomy aligned. Now, when an investor takes this company and puts it in their investment portfolio, and in this case, together with another company, then they calculate the individual weights of the companies in their portfolios and their, in this case, net turnover KPI, and then they can calculate their own KPI, which is called the green investment ratio. So this is fairly simple, very straightforward. The beauty of this is in simplicity. What it does, it makes all companies across all economy comparable, because the KPI is not dependent on your sector, it's not dependent on your environmental objectives or impacts. It simply is percentage of your net turnover that is compliant with sustainability criteria defined in taxonomy. And the same is required to be reported for CapEx, capital expenditure, and also operating expenditure. This is an example of actual reporting of the EU taxonomy, a very well-known company, Volkswagen, manufacturer of cars. And we can see that, for example, they have 11.4% of sales revenue, which is the net turnover in European terms, meaning that more than 90% of their revenue is not taxonomy aligned and therefore not sustainable in terms of taxonomy definition. They also report on their capital expenditure, which is significantly more aligned, which basically indicates that currently only 10% of their cars or 11% of their cars are sustainable vehicles, so low emissions vehicles, but they are already investing, so they're investing CapEx to build out these capacities in the future. So this company, we can see that it is transitioning to a more sustainable state in the future because they're making significant CapEx investments. Further, so these are the other missing elements, which were the links with the other sustainable finance framework building blocks. And we can see that in Europe, there's a very clear definition of how, for example, the taxonomy links with each of the other key building blocks here. And usually it has some sort of mandatory use of the taxonomy, either in terms of reporting or specific taxonomy aligned thresholds that you need to apply. For example, when you call something a green bond or a sustainable investment product or fund. All right, let's dwell a little bit on the sustainable investment product labeling. I know that we are fairly short on time. I want to leave 10 minutes at the end of the webinar for your questions. So I will only touch upon this briefly. This is what is happening in Australia and the announcements that we have had so far in terms of developing a sustainable investment product labeling regime. In the latest budget, there has been a specific commitment to devote 1.6 million over the next 2 years to consult on the development of retail investment product labeling regime. So the wording consult does not indicate a very high commitment, but it does indicate that the work will be done. In addition to that, ASIC has significant budget for the continuation of enforcing greenwashing and sustainability-related misconduct. So, of course, until that point where we have a clear labeling scheme, the ASIC will be using their own guidance on avoiding greenwashing, but also their own judgment in terms of whether any of the sustainability-related statements, especially in financial products and services, are misleading or not. So we do have the budget commitment to develop the labeling regime, which would include labels for managed funds and also for superannuation products. And there have been a number of stakeholders that have been calling for this labeling regime, A, to exist, and B, to be as aligned with international existing frameworks and labeling schemes and classification approaches as possible, which, as I will show you on the next slide, may not be that easy because they are, again, internationally quite diverse in how these are being set up and defined. We don't have much news around the progress. If anyone knows any news around how this is progressing, do let us know. You can type that in the Q&A. But meanwhile, what we can expect that ASIC is pursuing those entities where they suspect that there may be issues with their sustainability statements and they may not be living up to those statements in their actual investment allocations or other actions. And we have been seeing ASIC being successful with a number of court cases that have now been finalized with significant consequences for those entities. So this is something that everyone should be aware of and actually taking care of that risk and being very, very clear about your sustainability statements. This is a quick overview, and this is not complete, not comprehensive, but just an image of the different labeling, certification, and also classification regimes in other jurisdictions. So far, until recently, most of these were voluntary labeling schemes that were independently managed. Increasingly, we have the movement towards more government-defined, regulator-managed and regulated both certification schemes. Sometimes they're called labeling, sometimes they're called naming rules, nomenclature. So the different wording that's being used. Some of them are the more regulated ones are usually in development. There are some jurisdictions such as UK, for example, that is quite ahead of others. EU is currently developing a clear labeling regime. Initially, the Sustainable Finance Disclosure Regulation was misused as a labeling scheme. That was not the intention of the regulator, and therefore there was a big review of that regulation. And currently there's work ongoing, and I do have the privilege to be involved in that work myself as well. And that's a really, really interesting development there, because Europe is also taking, or the recommendation that we have put forward is for Europe to take a clear outcomes-based approach in their labeling, which is not necessarily the same approach that's taken in other schemes, which sometimes are more effort-based, right? So an effort-based labeling scheme will look at what kinds of processes or policies an entity, let's say an investment fund manager, has in place to consider sustainability factors in their investment decision-making, or it may be engagement with their investees, or they can be certain exclusions. That is all effort-based, right? Effort-based does not necessarily reflect what is the end outcome of those investments. In Europe, the recommendation is to take the end outcome approach and perhaps also mandate certain percentage of investments that have to be either taxonomy aligned or aligned with other sustainable investment definitions for a fund to be called sustainable. So the effort would be part of that, but it really is the outcome that matters, and that is the way forward that has been now recommended for Europe. The other schemes, again, you might use this for your reference if you want to look into any other of these schemes. They use quite different approaches, so they are mutually really hard to compare and also align with if you would like to align with a number of these. What is currently in existence in Australia is the RIA Responsible Investing Certification Scheme. So if anyone wants to get certified already now and have a bit more credibility behind their product, behind their claims, and also their own peace of mind that yes, their product, they can market it as sustainable investment product or responsible investing product. The RIA scheme is the currently most popular one and most widely used in Australia and also New Zealand. Again, I will not go through any details. We do not have the time, but do look into that if that is something that could be of interest for you. And this is also important to know for those who are retail investors, because these labelings, these labels, is something that can indicate to you that certain investment product is sustainable or responsible, and there are certain definitions of what that means. So let me, as the last point, talk through what are the practical implications. So this is quite complex. There are so many terms, terminologies. If you would want to read through all the documents that define a sustainable finance framework, let's take the most advanced, the European one, it would be hundreds and hundreds and hundreds of pages of reading, technical terminology, not always very digestible. It does take time to wrap your head around it. So how do we put it in the more simple terms of what different entities could be doing? And I have split this up in two main types of entities that could be considering their engagement with sustainable finance. With the lenders, fund managers, so those who are making decisions on providing capital, and then the recipients, investees of that capital. On the capital provider side, do consider your commitment to sustainable finance, whether that's something, if you're already committed to sustainable finance, whether that's something that still is up to date, that needs an update, or if you're not part of sustainable finance market yet, whether that is something that is strategically aligned with your values and your general approach and market positioning in relation to sustainability, whether that's something that you should be pursuing or start pursuing now. Your existing sustainable lending and investment frameworks, I know that quite a few financial services in Australia have their own sustainable investing and lending frameworks defined. Do take a close look whether there needs to be an update because of the regulatory developments, because of the changes in perception and expectations among stakeholders. This is something that warrants a revisit, and fairly frequently, because these developments are fairly rapid. Consider the use of taxonomies. If you're not aware, make yourself familiar with the upcoming Australian taxonomy, everything that's being drafted. Do actively engage in development of that taxonomy, because you are the main intended users. Even if it's not clearly stated, no one is mandated to use Australian taxonomy. The idea is behind that the financial services will be the first voluntary users of it. So do make yourself familiar and see how well that aligns with your internal approaches, and whether that could be a useful tool for you to use. And I do hope that it will be a useful tool. If you operate internationally, then you may need to consider the use of other taxonomies in addition, or interchangeably, or instead. Consider labeling certification. As I said, that gives you peace of mind, that signals to the market that what you're doing truly is sustainable, and you can safely go and market those products as sustainable or sustainability supporting. Be aware of your regulatory requirements, because again, this space is developing very quickly. You will be subject to mandatory climate-related disclosure requirements. If you enter other markets, you will be subject to a number of different regulations, and the number of those regulations is rising very quickly. Easy to fall behind and be caught out unaware. So being a very popular and lucrative way of raising capital and being active participant in sustainable finance markets. And that is the case both on the lender side, but also on the fundraising side and company bonds. We're seeing more and more private sector issuances of green bonds or sustainability bonds or other types of again, very important both on this financial capital provider side and the recipient side. As I said, there will be a lot of attention paid by the regulators, and not only regulators, but also the stakeholders. Entities are also regularly brought to court by various activist groups on their greenwashing claims, for example. And just do not do greenwashing. Just don't. We will be much better off, and be very, very careful about what could amount to greenwashing or not. In terms of companies, the additional things really is to consider your sustainable finance potential. If you want to consider the fact that that might open the doors for easier access to capital, or maybe discounted capital, this can be a significant advantage over other competitors or other players in the market. The moment you can demonstrate sustainability credentials, and especially if you can voluntarily do taxonomy alignments and voluntary reporting on that taxonomy alignment, that will put you on the front foot with the investors, both domestically or lenders, both domestically and internationally, and especially internationally, and especially with the European investors. As we saw, more than 80% of sustainable investing does come from Europe. So that's probably one of the biggest pool of fundraising potential for you. Report transparently, again, the same. Be aware of regulatory requirements, the same, especially companies operating internationally. the more markets you operate, your obligations will rise exponentially in the next 5 years. And we have had other webinar series on that. You can revisit some of our other previous webinars looking into that. One specific aspect for companies is also the management of your ESG ratings. That is becoming increasingly important, but also increasingly possible. One of the reasons why it's being increasingly possible because ESG ratings are about to be regulated. And again, the first mover, as very often, is the European Union. It has looked into the market and realized that there are a lot of market distortions. There's a lot of black box solutions, and it doesn't provide the service that will be required. And it's hard to rely on the current way that ESG ratings are being done. And therefore, it will be mandating, and there's already draft regulation, that ESG ratings providers have to provide companies the possibility to engage with the ratings, or at least understand how they are being rated, what the methodology has been behind, what information has been used. And so a lot of these ESG rating providers are already getting ready for that and providing the opportunity. So there is much more openness and much more interaction possible currently with those ESG ratings providers. Why is it important to engage with those? Because if you are a listed company, then you will be automatically be rated. That's one. But second, the investors, and especially those investment products that are passive, they will be tracking these ESG ratings very often as the selection tool for who is included in their sustainable portfolio and who is not. So it is important, if you want to be present, be selected and be included in sustainable investment portfolios, to be aware and manage your ESG ratings. All right. I know that we are almost out of time. I will just leave you at this, and apologies, we have really had very little time for questions and answers. I will very quickly look at the list of questions. Darian, I might need your help because unfortunately I do not have the question and answer button on my side. It may be that you may need to read the questions out to me if you do see them.
Sure, no problems. So we've got a question here. Thank you, Linda. In the future, can you see a convergence between BAU investment criteria and green taxonomy investment criteria? And what could that mean for returns and cost of finance?
Yeah, very good question. I do hope, and that's my hope, and I think it will happen, that all investments in the future will be sustainable investments. The question is only how fast it will happen. And I don't think it will be very fast everywhere in the world. It will take some time. It may move faster in some jurisdictions. And obviously, I've been mentioning Europe very often. It may move faster there. We do not see the same pace of change in US, for example. We do not see the same pace of change in many developing countries and regions, except perhaps for Asia. I think that the pace of change will be different everywhere. At the end of the day, at some point, we will come to the point where unsustainable investments will simply be too risky, right? The risk profile of them will not justify investment in them, and over time, they will also not be as profitable. So I do expect that these curves will sort of cross, and we will see, and over time, it will indeed become business as usual to take into account sustainability aspects when we are investing. Do we have any other questions?
No other questions at the moment.
Okay. There may be a possibility for us to unmute one or two people. If you are willing to speak out and unmute yourself, you can raise your hand. You should have the capability to raise your hand. I'm not entirely sure whether you do. But if there are no further questions, thank you very much for joining. On the slide, there is a range of different services that we are providing on sustainable finance in RSM. It's pretty much the whole range of the different services on everything that we have been speaking about today, be it compliance, be it consulting or second-party verifications. All those services can be provided. We have a large team of sustainability experts, and we provide these services in addition to the other range of different services as professional consulting firm. Thank you very much, everyone, for joining me today. There is a very quick survey in the chat where we'll be happy to hear how you found this webinar, whether that was useful. And also, we are always happy to hear whether you want to hear more or have more sessions on the same topic or maybe other topics related to sustainability. Your responses will help us shape this webinar series in a way that's most useful for our audiences. Thank you very much, everyone.